when you've got mixed income communities, everybody wins because you're creating diverse communities. A lot of times, Section 8, depending on your market, many times will pay at market rates or sometimes above, but there's less volatility in lease up and continued leasing of those units versus a market rate unit. And so not only are you creating affordable housing unit opportunities for communities and families that need it, but you're also lowering the volatility and potentially raising the returns on your property.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 387. My guest today is a business leader, educator, and public servant who has dedicated his life to advancing economic opportunity for underinvested communities. And while Evan Shields has led the investment, development, and asset management of over $4 billion in institutional commercial real estate assets, he's also realized that there is a huge disparity when it comes to who is actually at the table making decisions. Today, we're going to discuss the need for more diversity, sustainability, and economic mobility that Evan is focusing on through his company, Indelible Capital Partners. IndeliCap is on a mission to invest $1 billion over the next decade in real estate with an indelible impact on our world. As an owner and operator, IndeliCap strives to revitalize communities through the acquisition and development of market rate, mixed income, workforce housing, and single-family rentals across the Southeast U.S. Evan, welcome to the show.
Brian, thank you so much for having me. I'm very excited for our conversation today.
I was looking at your website and it really kind of struck me that your mission is different than a lot of people that I've had on the show. And I'd like you to kind of, from your perspective, and you come from the institutional side, the investment side, you've been around, a lot of different types of real estate and real estate investors. What are some of the problems you see with this world that we all exist in right now?
I think one of the big issues that we have is there is an asymmetry between capital and the needs of our communities, particularly underinvested, undersupported, or resourced communities across the U.S. And that issue has honestly been in existence for quite some time in America for a lot of different reasons that are maybe beyond the scope of our conversation today. But let's talk about solutions and the path forward. I believe that economic mobility is something that everyone in our country should have the opportunity to access, especially if we can open those doors. And I think in a lot of ways, as a real estate investor, as a aspiring developer in our space, I want to connect the dots to connect capital to communities in need. And that's why I formed Indelible Capital Partners, IndeliCap for short. As you mentioned in the intro, we're on a mission over the next decade to invest $1 billion in commercial real estate that elevates access, equity, and returns for not only our investors, but all the stakeholders that we serve. And one of the big issues is, actually, let me really talk about why I got into this, because I think it really frames up my worldview here. So I actually graduated from the University of Virginia. I started my career as a teacher in low-income schools in the South Side of Atlanta. It was honestly, next to investment banking and fatherhood, the toughest thing I've ever done in my life. And I'm teaching ninth grade algebra in one of the worst performing schools, unfortunately, at that time in metro Atlanta right around the end of the Great Recession the beginning of our very slow recovery at that time. And to be honest, we had a 40% graduation rate at my school. We had an 8% male graduation rate. That meant that as one of my young boys that I was teaching, all of them black and brown at that time, you were more likely to be dead or in jail than to graduate high school. So we had to really think outside the box about how to actually not only get to our youth, but empower our community. And so I started getting deeply involved in the community, a lot of community organizing, having a lot of very strong conversations about how could we turn things around. And I recognized that economic mobility, or the lack thereof, was one of the biggest deterrents for my community getting ahead. And that real estate was one of the best solutions to do that. Now, oftentimes we talk about economic mobility in terms of empowering investors, which I think we should always do. But I think at the same time, we can empower communities too. And I started to realize that a lot of the reason we have this disconnect between available capital and opportunities for economic development is because a lot of the folks who may be at the front lines of those type of stories or those type of initiatives simply are not at the table or in the conversation. Unfortunately, commercial real estate in our industry as of recording in the year 2023 is less than 3% minority. And that's not just including Black and Hispanic, that's including and Native American, that's also including Asian folks. Our industry is less than 40% women. I believe the last figure that I saw right around the time of the pandemic, 2021, was 37% non-male representation in our industry. And if we're going to solve this issue of economic mobility and development in communities of need, we've got to increase those numbers. And that's why a lot of what I'm doing is not only elevating access to capital for investors into great deals, but also elevating equity. I use that as it's really equity in more ways than one. Not only equity in terms of equity multiples in deals that I'm doing, but equity in terms of the communities that we're serving and really trying to elevate equitable living for every stakeholder in our community. And that's why I started this company and why I'm really excited to be one of the very few impact-driven real estate developer, investor, owner operators in the U.S. I hope that my work helps create more companies like mine.
What are the actual examples and real world solutions you've come up with to help tackle some of, bring more equity to the table and more community participation?
First and foremost, my investment thesis broadly, let's just talk from an economic perspective, is when I'm looking at investing $1 billion of AUM over the next year, that's really 25 to 30 million this year, hopefully 40 to 50 million next year in 2024, et cetera. And I'm really looking to do multifamily deals that are a mix of both market rate and also affordable units and also short-term rental / corporate leasing. But when you drill down, a part of my investment thesis is my impact criteria. And my impact criteria is that in every deal that I do, I really try to focus on one, two, or all three of three variables in my impact criteria, which is one, wherever possible, trying to uplift diverse operating partners. And by that, I mean capital partners, whether it be bringing on co-GPs into deals from a diverse background or diversifying my investor base, but also when we look at specifically operating partners, making sure that I am upholding diversity in my procurement, in general contractors and architects, in my lenders and the relationship managers of those banks or other lenders that I'm working with. The other thing that I always try to do is focus on deals that have a transformative community impact. And so by that, I mean the opportunity to create more affordable housing units in a community that needs it, in a way of creating master plan developments that can create new neighborhoods or revitalize under-resourced ones. I think real estate is one of the greatest paths for economic mobility for communities that need it. And I want to help create jobs, create a livelihood, create a bigger tax base in communities that maybe are underinvested. The other thing that I really look at is sustainability. One thing that we have to recognize is that the UN and many other folks who are helping us set our global climate goals have helped us realize that real estate and infrastructure contribute as much as 65% or more of global climate emissions on a yearly basis. And if we're ever going to get to net zero, or hopefully someday net negative in our climate, carbon emissions and across the country and the world, we got to figure it out in real estate. So I try to look for existing deals that maybe have an adaptive reuse play, where I'm acquiring an asset that took a old, aged structure, maybe something that was an eyesore, and helped redevelop it into something beautiful that's community centered, like great affordable or mixed income housing, or a mixed use asset, or flipping office or hospitality to multifamily uses or retail uses. I love that. Trying to think about sustainable construction products, sustainable and architectural design, thinking about how can we streamline our utility spend in this building, and maybe infuse solar or other opportunities for clean energy in the footprint of the asset. I'm really thinking outside of the box. And to be honest, I don't even have like a rubric or even a benchmark or a scorecard. For me, like any other business leader or entrepreneur, it's about philosophy. It's about infusing this into the philosophy of my business and how I characterize and evaluate and analyze deals. And I think that this is a different way of thinking about things that I think hopefully pushes the envelope of what's possible on not only risk-adjusted returns, but also, really economic development in every deal that I touch. I'd love for more businesses, whether you are a diverse or emerging manager, or maybe you're not, to think about these, kind of principles and see how can I manage the triple bottom line of people, but also profits and purpose.
How would one take the principles and the criteria that you just highlighted there, which I think are fantastic, and integrate them into their business? And what are some of the challenges that you find in like bringing more diversity and equity to the table? I mean, it's one thing to say, I want to achieve this. It's another thing to actually go out and do it and overcoming those challenges. I'd love to hear how you accomplish that.
Well, let me talk about how I got into real estate, because I think it's a microcosmal story of how we can empower other folks of diverse backgrounds to get into this space. So to give some context for our folks who are listening to the podcast audio version of this rather than watching, I'm a young African-American male. I come from a working class family from the industrial Midwest, right outside Chicago and Gary, Indiana. My whole family are teachers, preachers, unionized steel workers, et cetera. And so I kind of really grew up with a service bent and background, which is why I became a third generation teacher. And that experience changed my life, because I not only realized that real estate was a pathway to economic mobility, but that I could see myself being a leader in this space, a mentor in the community organizing space, who was also kind of attached to a couple of business deals in Atlanta, said, hey, you should think about reading this book by Don Peebles, The Peebles Principle. It's a great book, great memoir. For those who don't know, Don Peebles, he's an African-American developer who started from nothing and built an amazing empire. across San Francisco, DC, Miami. And he looks like me. And I read this book and I said, all right, well, if he could do it, I can. And I was a teacher. I did not know pro formas, finance, economics, accounting, diligence, anything about real estate. But what I did was I said, this is where I want to go. Let me try to research as much as I can online. I mean, there wasn't as much content on podcasts and YouTube and other stuff back then. But then I just literally just went on LinkedIn and just started reaching out to people in my network and said, hey, I'm an educator. I want to break into real estate. Would you sit down with me for 15, 20-minute coffee? Now we have the benefit of Zoom, which didn't even exist back then. It makes it a lot easier to connect with people. And I had over 100 conversations with everybody in the industry, from brokers to bankers, developers to attorneys. And I got a chance to see at least how every different aspect of the industry kind of played out. And I think for people from diverse backgrounds who maybe have imposter syndrome and don't want to break into our space, sometimes it takes hustling and putting yourself out there. But for other folks on the other end who may not necessarily be a diverse individual, but want to empower other folks like me to eventually join their firms, be open to having those conversations with folks who come from different diverse backgrounds, not only in terms of race or sexuality or ethnicity, but maybe in terms of also professional background, because you'd be surprised. They might be an A player and a star for you. And so I think a lot of it is just changing and shifting the mindset and being open to who we bring into the space, and not just saying, I've got an open analyst position. Let me just hire my nephew and see how it works out. I think sometimes we've got to think outside the box and be open to it.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com.
What about challenges that you experience in the sustainability part of it, like adaptive reuse and things that might be more beneficial to the environment? Do you find that there is a push and pull between what you think is sustainable or what you want to be sustainable and the money that might be available to help get you there?
Let's just be honest here. We are just now scratching the surface of what sustainability looks like in real estate. I think real estate, I joke around all the time. We are the last frontier of innovation of so many industries. Not only in terms of diversity, like we were talking about, but also technology and, of course, sustainability. So I think at this point in time, anything we do in the realm of sustainability can do nothing but help us out as a society. But let's be honest. When you work on sustainable, there is a massive effect to the bottom line of your property by infusing sustainability in what you do as an asset manager, owner, operator, and developer. Let me give you a couple of examples. I mean, the agencies, Fannie Mae, Freddie Mac, and I think FHA might be starting a program too, for at least the last 5 years, have had a program where they will give you an incentive to essentially take an existing value add asset and create utility efficiencies, water, energy, et cetera, in your property, and actually give you some credits and how they structure the deal that work in your favor. Some of them call it a green loan program. Okay. I think about sustainability in that way, and that helps me with my loan that I get from my lender. All right, awesome. Across the Gulf Coast, Atlantic, I'm talking Texas here, Georgia, Louisiana, Alabama, Florida, the Carolinas, we're dealing with a massive insurance crisis, particularly in Florida and certain parts of Texas. And it's because we're dealing with the specter of climate change and sea level rise. And, a lot of volatility when it comes to these massive storms that we thought would only happen once every 10 years. Now they're happening multiple times a year. But it turns out that if you uphold sustainability in what you're doing, hey, let's have more sustainable design. Let's have better constructed assets that are just not sticks and bricks, but also concrete. Let's think about having hurricane resistant windows. Those are small things some of them are big, but some of them are small that can lead to you having a lower insurance premium and line item in your underwriting for your asset. And so, these are things that some of them are big and some of them are small, but every single example I just mentioned can affect your bottom line. The challenge now is matching up capital with the needs of sustainability. Adaptive reuse, especially, is one of the hardest, I'd say, business plans in our commercial real estate space right now to finance, because only a certain amount of lenders can really wrap their heads around it. And more times than not, you're going to a non-bank lender like a debt fund to be able to finance those type of business plans, and it's not going to be cheap. And I recognize that. You might also have to think about creative financing on deals like that. Once upon a time, I was a lender. I worked for a debt fund where I was a senior executive at one point. I also was a junior executive for an affordable housing bond fund. And many times we would provide affordable housing bond and LIHTC equity to amazing adaptive reuse projects that had an affordable housing component. And it was at a decent cost of capital to developers. Sometimes we have to think, if you want to uphold those type of sustainable business plans, we have to think outside of the box of what capital sources we use. New market tax credits is another bucket that a lot of certain asset managers can really tap into. And this is not an easy space to figure out because, part of the reason a lot of folks, unfortunately, don't get into the tax credit space in real estate is because sometimes it takes a lot of brain damage just to figure it out. You spend more time trying to think about the creative financing structure for your project than actually thinking through architecture and design and how am I actually going to get this deferred maintenance done, brought back up to code or up to snuff, et cetera. So there's certainly challenges, and I'm not saying that it's easy, but what I am saying is that I'm specifically equipping my firm to take on these challenges, and I'm very excited about it.
Let's talk about community impact, because that was one of the three pillars that you talked about, the effect on the community and including the community when you're thinking about developing or investing in that community. Can you give us some concrete examples of how you've accomplished that in your own portfolio?
Listen, let's step back a little bit. I have had the blessing of the almost 10 years that I've been in this real estate space that have been a part of $4 billion of institutional and middle market real estate transactions. Every asset class, every corner of the country, mostly multifamily, with a good chunk of that being an affordable and mixed income housing. And I'm just now building my portfolio with the goal of hopefully, knock on wood, hitting 25 million of AUM or more in 2023. That said, one of the most important things on recent development projects that I've had a chance to build, workforce housing, is don't just build with the community in mind. Like actually talk to people in the community that you're going, the submarket that you're going to be building in before you break ground, before you go out to zonings and entitlement reviews with the local government. Because when you're doing new construction, and this is of any asset class, any project, whether it's community focused or not, if you have those community conversations up front, it's going to make that entitlements process that much easier. But it also benefits you and the community in that they might actually bring up the different needs and give you answers that you kind of need as a developer that really meet and address their needs, whether it's infrastructure repairs in and around your property that can really help the community. Like, hey, this we're building this asset in Detroit, and like on this street right in front of your property, we've just had potholes for so many years, and it's just really affected our livelihood. Well, maybe if that's something that you can include in the business plan, if you've got the capital allotment to tackle it, or maybe it might also be, hey, there's an adjacent parcel next to your site. We've always wanted a park, and that space, its highest and best use may not necessarily be a parking garage that's adjacent to the multifamily, or it may not be multifamily directly. All right, great. Let's figure that out. But I think getting to a base level, there's always a need, especially in the Sun Belt, for affordable housing. Whether you're in Charlotte or Phoenix, whether you're in Miami or Dallas, we're in high growth population areas, high job growth areas with limited stock of housing. And if you are a value add investor or developer like me, especially, we have to think to, okay, in our pro formas, how can we build in obviously market rate options that increase at a good enough clip to give us the IRR that we need to bring back to our investors. But let's also think about how can we preserve or create affordable housing opportunities. One of the things I'm trying to think outside of the box of in my deals is, okay, let's say I've got a 20 unit value add, let's say class C plus or B minus deal that I'm acquiring. I'm looking at, all right, what if I had a 5 to 10% set aside of affordable housing units? One thing that would surprise people is when you've got mixed income communities, everybody wins because you're creating diverse communities. A lot of times, Section 8, depending on your market, many times will pay at market rates or sometimes above, but there's less volatility in lease up and continued leasing of those units versus a market rate unit. And so not only are you creating affordable housing unit opportunities for communities and families that need it, but you're also lowering the volatility and potentially raising the returns on your property. And one other thing that somebody can think about doing if that affordable housing set aside for whatever reason maybe drops the IRR by 2 to 5% is having another set aside of corporate flex or short-term rental units. Because the agencies, Fannie Mae and Freddie Mac, oftentimes will allow up to a 5 to 10% set aside of short-term rental units within the collateral of a building that they finance. And that's a great way to offset the rents of any type of loss on the affordable housing side within the same collateral. So a lot of this is just thinking outside the box and deal structuring that can help you as a real estate investor or entrepreneur better help the communities that you're investing in.
Given the criteria and kind of the algorithm that you have in your head for the different types of deals that you're doing and what you're looking for, what's on the horizon here? You talk about getting 25 million in assets under management, AUM, in the next year. What are those projects going to look like?
For right now, we're based in Miami, Florida. I am bullish on Florida, and I'm focusing specifically only on our state for deals that we sponsor directly. I'm certainly interested in co-GPing with other opportunities across the Sun Belt with other operators and kind of learning different markets and maybe some cool techniques and stuff like that. But most of my deals this year, I want to sponsor, be the lead developer or investor, owner operator. And within Florida, I'm focusing on really the Panhandle, so Pensacola, Tallahassee area, Jacksonville. More of my focus will be on Central and South Florida. We're talking Greater Orlando, Tampa Bay, and then South Florida being Palm Beach, Broward County, and Miami-Dade. I'm trying to focus on workforce housing, especially Class B to C plus assets that are 60s to 2000s vintage that have good bones, but might have deferred maintenance, CapEx maintenance that honestly need some love, need some tender care and attention, and providing market rate and affordable housing opportunities within the same collateral. My ideal project size is between 20 and 100 units per asset. And the reason I say that is because, you're going to spend the same amount of work and brain damage doing a 20-unit deal than you are a duplex. But a 20-year deal will make you a lot more money as a firm than a duplex. So you might as well do it. But also because given where we are in the economic cycle, I think that there's still a lot of institutional dry powder that is on the table that wants to be spent in the deals. I know this for a fact. And I also know that given a lot of the volatility we're seeing this year, that some retail investors may be on the fence, whereas during the pandemic, they may not have been. And so given that kind of asymmetry, I'm trying to look at deals that can at least be palatable for institutional or quasi-institutional investors until we get to a point where there's less volatility and I can open up the floodgates to more retail, because I'd love to do that.
I'm sure by the time this comes out, a lot of things will have happened in the economy that we couldn't even guess right now. But what are the headwinds you're seeing in 2023 when it comes to building that 25 million AUM portfolio?
One of them is an equity investor appetite. We already just touched on that. I mean, whether you're listening to this in May of 2023 or let's say December of this year, I think there's still going to be a significant amount of retail investors that are sitting on the fence. Many of them are, let's say, accredited investors or qualified purchasers even, who have, let's say a 2 million or more net worth, that unfortunately, because of a drop in stock markets and bond markets and tech, maybe they're invested in VC, they might, obviously see a drop in liquidity in their own personal portfolios and just lower their own allocation to real estate. And that's a headwind that we're facing. That's part of the reason why I'm really trying to pivot to some of the emerging manager programs that many institutional investor shops have. Sometimes you just got to ask, by the way. A lot of people don't want to ask, especially if you're approaching a family office or a large private equity shop or something like that. Like, do you have an emerging manager program? What are the qualifications for that? I'd love to be a part of that. The other big headwind is on the debt side. I mean, no matter any way you cut or splice it, there is so much volatility in the markets given inflation that we will probably be spending the whole of this year trying to get a handle of. And however the Federal Reserve responds to that with rate hikes or quantitative easing at some point. But also the specter of, as we continue to see expansion of rates, how is that going to affect jobs in certain markets? I think that the big thing is, by the time of this recording, we've had at this point, and I'm going to time date us, but I hate to say it, we've had 3 bank failures: Silvergate, Silicon Valley Bank, and Signature Bank. We've had another international bank failure with Credit Suisse. And we had one bank, First Republic, that almost was a failure, but ended up getting bailed out by its own peers in the banking industry. there may be more shoes to drop, unfortunately. But regardless of that, we're already seeing a drawback in lending appetite across the spectrum. And I think banks are going to be sitting on the sidelines, especially smaller banks, community banks, credit unions, regional banks. You're going to see non-bank lenders jump into the space with higher spreads than normal. I mean, not to say that any, debt funds rates, floating, fixed, or otherwise are normal or low. They certainly aren't. But you're going to see an expansion of spreads. And what I'm looking at, and every multifamily guy and gal should be looking at, is agencies. How are they going to be responding to this? Are they going to blow out spreads, or are they going to stay even? And, are they going to increase guarantees on debt? And I'm hoping that a lot of that volatility leads to some lower purchase prices on existing real estate. In fact, I'm banking on that. And I'm also banking on the fact that there were probably a lot of emerging operators who jumped into this space during the pandemic because real estate was hot then, that now, given the headwinds, probably have no idea how to deal with this from an asset management perspective. And further, might have floating rate debt that is putting their properties over their skis, so to speak. I think that volatility, if you're a savvy, institutionally minded, real estate entrepreneur right now, there's going to be a ton of opportunities this year.
What is your favorite hack or app?
Everybody's probably saying ChatGPT, just given like AI and da-da-da-da-da-da. I like Jasper AI, actually. Jasper AI is a relatively new app that is based off of an older version of ChatGPT, GPT 2.5. And hopefully they update it soon. And basically, it's specifically made for marketing purposes. And it's like GPT on steroids. And it's amazing.
And what can it do for you?
It can write podcast scripts. It can write articles for you. It can help create marketing strategy for you. It can help research and read an article and translate it into takeaways for marketing content. If you're a property manager, it can help write your emails for you to your residents. If you're an asset manager, it can help you write your updates to your investors on the asset management of properties. I think it's pretty phenomenal. Another hack that I'm exploring and excited to jump into is CoStar. CoStar has been around for a long time, but they've put in some new parts of the software that allows me to look at non-performing debt across the country and to look at multifamily assets that match what I'm looking for, 20 to 100 units, Sunbelt, preferably Florida, that have non-performing debt on them. And I can actually call up those owners and just make new off-market opportunities like that.
How would people find out more about you or get a hold of you?
Website, IndeliCap, IndeliCap.com. You can find me on LinkedIn, Evan A. Shields, or Instagram, Evan A. Shields, or Indelible Capital Partners. Pretty easy to find there. And looking forward to engaging with folks and seeing how we can work together.
Well, Evan, thanks for coming on the show. I enjoyed our conversation when we met in person, and you really knocked it out of the park today. It was a real pleasure. And thank you for talking about, some of the things that are very important to you in this business, whether it be equity, inclusion, diversity, and sustainability, all great things that we should strive for in our own business. And I think you've given us some pointers on how to do that. Thank you so much for having this conversation today.
Oh, Brian, thank you so much for having me. I really appreciate it. And hopefully we do this again a year from now. Maybe I've got like 100 million assets under management at that point. We just say, man, you really knocked that park, Evan.
If you have 100 million, come on back and we'll talk about it. Thank you.
All right. Thanks again, Brian.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.